What's going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Canopy Growth Stock, ticker CGC. This is one of the popular cannabis companies out there. They operate under several different cannabis brands, and they are engaging in the production, distribution, and sale of cannabis and cannabinoid products. They are a Canadian company. Their market cap is $677 million, and this stock has had quite a run the past 10 days or so. This stock was only 38 cents a week or two ago, and now it's 92 cents. So the stock is up over 100% in the month. But if we go out a little bit further and look at what this stock has done for the year, it's down 72%. It used to be a $3 stock, so it came down quite a bit. And then years ago, it even used to be, it's down 98% from 5 years ago when it used to be a $40, $50 stock. So this is probably one of the most volatile stocks you're going to be able to find out there. But the reason the stock has been shooting up is for one main reason, and then there's also a side reason. So on this website, it says that the main reason is because the government it says the U.S. Department of Health and Human Services told the Drug Enforcement Agency that it thinks cannabis should be knocked down from a Schedule 1 narcotic to a Schedule 3 status. So it talks about how Joe Biden and other people in the government are discussing legalizing medical marijuana, which would be a giant catalyst for these cannabis companies, right? Then the other reason is that there's studies that came out showing that the benefits of medical marijuana as well. So those are the two different things to take into consideration. As for Canopy Growth Stock, if we look at their revenue, I was actually kind of surprised because I was expecting more growth out of this company. And I know from this, 2014 to 2021 era, there was incredible growth, of $1 million all the way up to $540 million. So that's huge, right? That's a lot. But not only did it decrease in 2022 and it decreased in 2023, but when you go to see what analysts have them doing. Now, maybe this is going to change now, because that's a big part of this too, is that this is nearly impossible to predict what kind of growth these companies are going to have, because nobody knows when it's going to get legalized and what all the laws are going to turn out to be in each state, all that different stuff. But as of right now, they have them growing 4% this year and 2% next year. Maybe those are like the this is coming from 13 different analysts too. So maybe that's just like the ultra conservative estimates for this company, and they're just being safe and careful. And then if something comes out and states legalize medical marijuana, then this number could shoot up to, who knows, 50%, 100%. Who knows what it's going to look like. But that is their revenue growth. So unfortunately, it's not the most consistent thing. If we're talking about a strong trend and consistency, that's not really it. Although they've had some enormous growth, the consistency and the security is not there. Net income improvement, no. As you might imagine, for a stock like this, their net income is getting worse. They did negative $3 billion last year. So, keep in mind, that would be a big problem if when this stock was $40, that would be a big problem. Like, I wouldn't be buying this at a $30 million or $30 billion market cap. But when we're talking about $1 billion or under, like, that's very understandable for them to be losing money and stuff. Then, of course, they don't have a PE, so we look at their price to sales, which is trading at about 2x times this year's expected revenue, right? So here is the graph for their price to sales. And as you can see in the past, it traded up to 30 times sales. And now it's got a little bit more reasonable. And it was hanging around this 2 to 3 range for nearly a year, and then now we're back up to 1.5. It said 1.5 then, probably because, well, actually that's for today. But if you run the numbers for on a forward basis, they're doing $300 million, and the company's valued at a little bit over 600. So it's about a little bit over 2x their forward revenue, right? Innovative, yes. I think this is a company at the forefront of this whole cannabis trend, the whole market. So the innovation's there. The market share, no, they only have about 0. There's no real number on this because it's so early on, and there's literally 1 million competitors doing this. So of course there's not going to be strong players or a player with a big market share. But it says revenue in the cannabis market is expected to be $51 billion in 2023 and growing at 15%, which would double it in the next 5 years. Okay. Well, they're only doing 300 million. So that's less than 1% and not a lot of market share. Return on invested capital is negative, of course. Equity, this was slightly disappointing, slightly understandable. Keep in mind, all these numbers are in the Canadian currency, so you have to translate it. It translates to 73 cents in US currency for 1 Canadian dollar. So I just look at it like I try to take 73% of whatever the number is. So as you can see, back in the day, it was over 5 billion. Now keep in mind, this is when the market cap was exploding and everything, but 5 billion, 3 billion, then it dropped to 700 million. Now it's slowly coming back up, but still it's down from pretty much any place it was at in the past. Now we're at 800 million. But remember, 73% actually translates to only about $600 million, which is pretty much the market cap. So you're pretty much paying the market cap. And that from that perspective, this looks like a fantastic deal to be buying the stock at these prices, which makes me kind of interested. But again, I'm not into buying money losing companies. I'm not into buying really risky investments. So I'm probably not going to jump on this just yet, especially because it's hyped up. A lot of different things could happen. This stock could be cut in half tomorrow. Who knows? So something to keep in mind. But I like to just see, I don't like to see a lot of goodwill as a large percentage of assets. So this is not bad. 200 million. It's only about, it's like 10%. It's like 10% of their assets. So that's not bad at all, really. I mean, you're getting pretty much $600 million of real equity, like not counting goodwill. And if you bought this a month ago when it was half of that, you could have bought this company for $300 or $400 million and been getting $600 million of tangible equity. That would have been an opportunity right there. And even right now, you're pretty much paying a book value of 1x, which is good. Equity, it's as we just said, it's pretty much over, it's 100%, so that gets a check. Share count decrease, no. Although this is a really bad chart, it is normal for a company like this. We're looking at 29 million shares in about 10 years ago. Now we're at over 460 million. So this has gone up well over, 12 times, well over 12 times in the last decade. That's a huge dilution for shareholders. And although it's getting a little bit better in the last 5 years, 4 years, I guess it's a little bit better, but still not good. That's not going to help the share price at all. I mean, the share price can still, I guess the market cap is so small at this point that as investors put money into the company, that's probably going to have a much more substantial effect on the stock price going up versus the small effect from them issuing more shares. Okay, so keep that in mind. Even though it looks bad, the stock can still go up. Assets minus goodwill, no, but it is close because we're looking at 2 billion of assets, 1.3 billion in liability. So they're close. Definitely, it's not bad. It's better than a lot of other companies. Profit margins are negative. Cash receivables are sitting at what? 700 million or so. So more than income. No dividend. The company's founded in 2009, and their free cash flow. This one, I almost thought about putting a yes, but really it is it's always negative, and there's been some improvement in the past, but not consistent, and it's also been stagnant for the last 3 years. So here's regular free cash flow. Okay, we're looking at negative $560 million, stagnant for the last 3 years, pretty much. Is it better than where it was 4 and 5 years ago? Yes, but it's not. It could be at least closer to break even. But then what we should be doing is factoring in that stock-based compensation that I was talking about, and then that makes things look worse because now we're talking what, negative 600 million compared to. So I guess it's not a big difference, but that's the effect that issuing the shares is going to have on this free cash flow, not helping. So this chart is kind of somewhere in the middle. From the years prior, it's improved, but from these years, it's well, from these years, it's improved, but from the earlier years, it's gotten worse. So you can look at that different ways. It really depends. Let's go on if we go on a quarterly basis, let's see if that makes it look any better. Nope, still looks stagnant to me. It's pretty much been at these levels since 2020. Yeah, so hopefully, I mean, once one of these laws gets passed, legalizing it, then that's what really what you're betting on. I don't know if I would want to bet on a company in this space yet. I mean, we don't know. We have no idea how this is going to play out. We don't know who's going to get lucky. We don't know who's going to be successful. We don't know who's going to get the partnerships. We don't know who exactly is going to be who's going to have the best customer experience, all that different stuff. So we'll have to see. We don't know who's going to get bought out. There's so many different factors. So it's interesting. I mean, the good thing, if you're going to buy into this, I mean, I don't know. This stock maybe the stock goes back to $3, right? Maybe it triples from here. That's a possibility. I wouldn't be surprised. But it could also go right back down to 40, 50 cents. But with that being said, how I mentioned this market cap of 670 million, with them having over 600 million in equity, I mean, they are a money losing company, so you have to factor that in. But I would value this. I mean, if we're being realistic, there at some point there's going to be some laws in the future that are going to favor this company's financials, right? Then when that happens, they're going to make some money, most likely, hopefully a profit. It could take a couple of years, could take 5 years, but hopefully a profit. When that happens, then you could start seeing the company be valued at, then it would make sense to value it at $5 billion or $10 billion. Right now, I would not value it at 5 or 10 billion. I would value it at like 1 billion, maybe 1.5 billion, maybe 2 billion if you really want to, play it risky or you really think this is going to be the company. But it's pretty early on to make a big decision like that. So that is my stance on Canopy growth. Thank you for watching, and I will see you in the next video.